before we start talking about how to save taxes, this is an important 101 basic knowledge that you should understand, that depending on where your money comes from, the tax rules differ. Okay, different income sources, different tax rules. Okay, so you'll probably understand this better when we explain it this way. So you could have income coming from agriculture, or you could have income coming from a salary. You could have income coming from running a business or a profession. You could have income coming from properties that you own, residential or commercial or farmland properties that you own. Or you could have income coming from the sale of capital assets, or income from capital assets in case you have a property or jewelry or shares or patents. They are called capital assets, and when you sell them, if you make a gain, they are taxed in a certain manner. And you could have other income. They could be gifts, or they could be earnings from lotteries, or it could be just interest that you earn from your bank, right? So these are income from other sources. So we saw 5 different sources of income, and each of these sources are taxed differently. It's very important for us to understand that. Right? How is agricultural income taxed? Agricultural income is exempt from income tax. In India, as on date, it's exempt from income tax. How is salary income taxed? Salary income is, of course, taxed as per slabs mentioned earlier. Your first 2.5 lakhs is tax free, and then it's 5%, 10%, 20%, 30%, right? So, as per the tax slab, your income tax is taxed. You can't incur a loss under this head, but you can get some adjustments as standard deduction and a few other exemptions that you can get in HRA and stuff. How is business income taxed? Business income is, of course, taxed as per slabs mentioned, but expenses incurred to run the business can be adjusted against the income earned, which you can't do with your salary income. There is a standard deduction which you can deduct, but expenses incurred to run the business can be adjusted against income earned from business. So you can typically incur a loss in business income, and this loss can be set off against other income except salary income. So if you you have already also a salary income coming in and also a business income coming in. Let's say you also get an interest income, or you get rental income. If you incur a loss in your business, you can set it off against your rental income or your interest income, but not against your salary income. How is the house property income taxed? It's, of course, as per tax slab, but expenses incurred for maintenance, taxes, interest on loan can be adjusted, and you can incur a loss here again, because in case you're paying more interest than the rent you earn, then that's considered a loss in from income from house property. It can be set off against any income. It can be even set off against your salary income. Our capital assets taxed, they are taxed at a very special rate. Indian equity-based assets, if you have shares or mutual funds, then they are taxed in a manner which is 15% if the gains are realized within 1 year, or 10% if realized after 1 year. So for example, if you're investing a lakh of rupees and you hold those investments for 2 years or 3 years, and the lakh of rupees becomes 1.5 lakh rupees, and if you book those profits at the end of 3 years, the 50,000 rupees profit that you have booked will be taxed at the rate of 10%. If you book the same profit within 1 year, you'll be taxed at the rate of 15%. If they are non-equity based assets, then they will be taxed as per slab rate if realized within 3 years, or 20% adjusted for indexation if it's more than 3 years. Basically, understand that capital assets are taxed specially, and to calculate capital gains taxes, do refer to your chart accountant. So one important thing that you should understand is, yes, you can incur a loss with sale of a capital asset, and you can set it off. Of course, with share markets or with even selling property, you can incur a loss. So if there is a short-term capital loss, so if it is equity, short-term is considered 1 year. If it's anything apart from equity, short-term is considered 3 years. So if it is short-term capital loss, you can set it off against short-term or long-term capital gains. So if you make a loss from sale of a property within 3 years, you can set it off against all other income that you've gained, all other capital gains that you've made in the year, which means effectively you can reduce your tax impact. But if you have a long-term capital loss, you can only set it off against a long-term capital gain. You cannot set it off against a short-term capital gain. And losses can be carried forward and set off against gains over the next 8 years. So if you have a bad year in stocks or shares, there is a silver lining to it. You can carry forward those losses. And if you have a good year the next year, you book some profits, you can set it off against the bad year that you had, right? So that's not a bad deal after all. It's okay. How are other income taxed? So other income, of course, added to your slab rate. You can't incur a loss here, so there's no option for any set off or anything, right? So these are broadly the five um, tax sources, income sources, and they're all taxed slightly differently from each other. So money is money from wherever it comes, yes, but not for the tax man. Yeah. So in the next video, we'll talk about how you can